Hello there, and welcome to today's Fight with Fitz. I'm, of course, Keith Fitz-Gerald. Thank you, as always, for joining me. I'm back in my old studio for a few days, and I had a great workout just now, so I hope you're off to a great start, too. And we're off with regard to the market, speaking of off. All three indices are green, the early going as I record this. That tracks. Wholesale inflation in June fell 0.3% month over month versus expectations of being flat. Now, that follows yesterday's consumer price index report, which also came in cooler than expected. Between the two of them, right? Those inflation readings, I mean, traders have interpreted that as a sign that they can borrow more money and get to work as a function of falling U.S. 10-year yields because the cost of money has gone down. So that's good news, sure. But here's what two soft inflation reports doesn't change. Companies that can raise prices without losing customers are still rarer than hen's teeth. Companies that can do it for decades, not quarters, well, those things are even rarer still. My point is this. At the risk of sounding like a broken record, stick to the companies making must-have products and services the world can't live without, because those, my friends, have the potential to protect margins and generate gobs of profit potential for years to come. It's a short list, really, by the way. Anyway, here's my playbook today. Warren Buffett just said what I've been saying for years. The Oracle of Omaha told CNBC's Becky Quick, quote, "It's tough to find values when everybody is preferring gambling." I couldn't agree more strongly. This isn't a new complaint for him, nor a new observation. Back in May, Buffett compared the markets to, quote, "a church with a casino attached." Again, I agree. He's calling out this same explosion that I've been calling out in options trading specifically. Now, I thought to myself, gee, that sounds familiar, but, we've already been there. My point of view is that despite what many of the social media encourage you to do, real investing is quiet, patient, and mostly uneventful. It's like watching grass grow, according to my grandmother, Virginia Mimi Gruner, who, as you heard me talk about her before, was widowed at a very young age and who used a small life insurance settlement to become a very successful global investor before the term even came into vogue. It's supposed to be boring if you're doing it right. The goal was never to trade every headline or chase every hot name, and it never has been. It's to find a handful of exceptional businesses and stay with them for as long as possible. You got this covered, great. If not, and you'd like some help, I'll be here. Number two, Team Diamond just posted the biggest quarter in JPM Morgan's history. All right, I had a hunch that JP Morgan's numbers would be good, but I had no idea that they'd be the highest quarterly profits of any U.S. bank ever posted. Hoo-yah! Man, I love this business. Now, I hope you paid attention on Monday when I spoke about what I saw coming with the super savvy Stuart Varney ahead of the opening bell that day. And I hope even more that you did something about it, because you don't see companies like this. Adjusted earnings came in at $6.14 a share, blowing past $5.85 Wall Street expected. Net income was $21.2 billion, 41% year-over-year increase. Investment banking fees up 30% year-over-year. Equities trading revenue up 86% year-over-year. Managed revenue was, $58 billion. That's 27% year-over-year. Every single line of business posted a record. That's another thread worth watching, one that we have talked about many, many times over. Diamond confirmed that AI has already helped the bank cut certain roles by 30 to 40%, but with most of those folks moved elsewhere in the company. That's significant. This isn't a robots coming for your job story, but the most powerful bank in America is already running on AI efficiency quietly at scale story. That's what you want to think about. So here's an investing tip. JP Morgan isn't winning because the environment is easy. It's winning because Diamond and his team run the best managed bank in America in good times and bad. Quality compounds, it builds. Buy the best, ignore the rest. Number three, what's next for PayPal? Well, PayPal shares are jumping 19% in pre-market trading as I record this after news broke that Stripe, yet the company that was supposed to be eating PayPal's lunch and private equity firm Advent International made a joint offer to buy PayPal for $60.50 a share. That puts PayPal at $53 billion, 28% premium to Tuesday's close. So, what to make of it? Well, PayPal has struggled to reignite growth, issued weak 2026 profit guidance earlier this year, and has experienced 3 CEOs in the last 5 years. Wow, revolving door. Anyway, here's the thing. I don't think PayPal is broken per se. It's just been drifting, and its drifting companies eventually get bought by people who aren't afraid to steer. And yes, that's when the real value tends to show up. So you want to pay attention. $6 billion in free cash flow? might actually be worth something. All right, funny how that works. Anyway, number 4 today, IBM, big buy, avoid, or whatever. IBM shares had cratered as much as 25% yesterday after the company warned of a weak second quarter, blaming a shift in corporate spending away from its software and mainframe business. Yeah, steamrolled is the term for that one. Ouch. Now, I've warned investors to stay away from IBM for a long time, years, in fact, because the company has always struck me as a company that's defending yesterday rather than building tomorrow. That's a big distinction. I prefer to invest in where the world's going, not where it's been. And I believe you me. I hope you have a similar outlook for your own portfolio because we stand on the cusp of what just may be one of these most significant transformative moments in recorded human history, what I call the sixth wave. And there's a chart in the written version of the 5 with Fitz. Take a look at it. I believe there will be more profits created in the next 10 years than the last 50 combined. All right. That's how innovation works and why I say that. Keith's investing tip. You can fight this all you want or listen to the yeah, but crowd if you'd prefer. I mean, a lot of people do both of those things. Either way, and regardless of how you and I feel about it, personally, innovation will continue and you guessed it, profits will follow. Getting your money there first can make all the difference, especially if you're using the right tactics to control risk every step of the way. Sometimes you got to be patient. And while you're at it, if you have no idea what to do next or what to buy, I'd like to toss my hat in the ring. You might find one bar ahead helpful. If you got this covered and you're achieving the results you want, then fantastic. That's excellent. You don't need me. But just in case. Number 5, Apple has finally found its sidekick in China. Now, I didn't see this one coming. It's a true holy smokes moment. Or if you prefer, if my rusty Mandarin is correct, that's bui hui ba, which is sort of like no way or it can't be happening. Alibaba has confirmed Wednesday that its Qwen AI model will be integrated into Apple's systems in China, powering Apple intelligence across iOS, iPadOS, macOS, visionOS for Chinese users. Now, Beijing's regulators gave the green light after nearly 2 years of waiting since Apple first announced its AI ambitions back in 2024. But here's the part that matters most for you as investors, right? Apple isn't trying to build the single best AI model on earth and never has been. It won the AI wars long ago, a thought that makes the AI apparatus positively apoplectic. Apple owns the device, the ecosystem in the customer relationship, and whoever makes the sharpest models, plural, gets plugged in underneath, market by market, on 2.5 billion devices worldwide. But here's the bigger thread worth watching. As I have long insisted would be the case, the dragon is coming to dinner, right? The choice that we've got to make, you've got to make as an investor is simple. Do you want to be at the table or do you want to be on the menu? It's just that simple. The AI world is splitting into 2 separate stacks, one built around US models and one built around Chinese approved alternatives. Open source, by the way, most of them. Companies operating globally increasingly need both, so it makes all kinds of sense to cover both from an investing perspective. See where I'm going with that? My POV, this is a great reminder of why I like Apple's setup. The company doesn't need to win the AI model race outright, and it never has, contrary to what a lot of people think. It owns the device and the relationship with the customer, and it can plug in whichever engine works best for wherever and whoever is operating on it. Now, that flexibility matters more than a single model's benchmark scores, the frontier, et cetera, et cetera, et cetera. So today's bottom line, very, very simple. The world is reorganizing itself around themes and in ways that don't respect Wall Street's old categories. So, invest accordingly, my friends. Now, and as always, let's make it a great day. Thanks for watching. You got this, and I will see you tomorrow from the same old studio. Have a great day. Make it a great day. Cheers.